Alrighty folks, we have a lot to get into in this video. I have a lot to show you guys here today. I have a lot of bad news to share with you. And that's unfortunate, and I don't like to share bad news necessarily. I don't get any enjoyment out of that. I saw somebody complain recently that, oh, Jeremy, he's giving too much, bad news and things like that. I don't like to do that, man. But at the end of the day, I got to give you what's going on out there and things like that. Like, I got to share that with you. With that being said, I was buying stocks out there today, and I'll show you exactly what stocks I was buying, what prices I was buying them at. But while I have everybody's undivided attention, I want to share this with you because and I think it's more newer investors to the market. Sometimes they have trouble understanding the concept of buying when things are bad. And what you have to be doing in 22, you have to be buying stocks. And I know that it's really, really difficult for a lot of people to understand because it's like everything's bad, right? And you see all this bad news coming out and all this bad data and recession and this and that. But the real truth is, you have to be buying in a year like this. And if you're not buying, you're making a massive mistake. And you can be very negative on the economy. Doesn't mean you shouldn't be buying stocks. You absolutely should be buying regardless of the situation. I pulled up since 1989, a stock chart of the Russell 2000, for instance. I could have pulled this up for the NASDAQ or the S&P or the Dow or anything like that. And it's all going to be pretty darn similar. So since I was born in 1989, we've had to deal with obviously many terror attacks, either domestic or foreign terrorist attacks, right? We had several wars. We had a once in 100-year pandemic. We had real estate crash. We had several recessions. We've had inflation, we've had gas prices go insane, we've had government be not very productive at times, as we know. We've had taxes go up, we've had taxes go down, we've had the Fed raising and lowering interest rates. We've had, the whole show, right? And all this has ended up just meaning buy the dip. The only ones that ever lose are the ones that sell during these crashes or the ones that don't buy. Those are the ones that end up regretting it forever, right? I mean, and these look like a blip on the scale, but at that time, these were all big falls in the market. All these, were big falls in the market. They just all end up looking like blips long term, right? Over as the years pass on and as the decades pass on, it looks like, oh man, it wasn't that bad. These were absolutely vicious to go through if anybody actually went through these. It was horrible, right? But the truth is, you should have been buying that entire time and nonstop. And as things come back, you still keep buying and you don't stop buying. You buy companies that you love for the long term that have great growth profiles in the future years and are expected to get margins in a better and better place. And if you take nothing else from this video, remember that right there. Now, with that being said, let me show you this. This is pretty big, okay? The Russell 2000 in the past 5 years is only up 28%. 28% gain in 5 years is horrible for the Russell. I mean, absolutely horrible. And that just goes to show you, how much trouble over the last number of years, a lot of the smaller companies have had, either due to perception issues or due to actual fundamental problems. Because obviously we had to deal with the 2018 situation, late 2018, had to deal with obviously the Rona crash, and now dealing with this messy situation. And even with all the money pumped out there and all those things, the Russell has just been such an underperforming index overall with a 28% gain. That's extraordinary because nothing is even close to as bad as that performance for the Russell there, okay? Now, I'm sure a lot of you guys saw the news. Inflation rose to 8.6% in May, the highest since 1981. It's horrible. I don't know what else to say. It's just awful. Core inflation, excluding food and energy, rose 6%. Surging food, gas, and energy prices all contributed to the gain, with fuel up 106%. I think, that's really hurting us bad right now. Gas prices being so insane. Yeah, it's just, yeah. Shelter obviously also is a problem. Rents have gone up quite considerably because real estate prices have gone up, and that's going to continue to be an issue for basically this entire year because of how many folks that have properties say, oh, this property is now valued at this because this is what this estimate is and this is what this could appraise for now. Good luck actually selling a home now, by the way. Good luck with that. That's all I'll say about that. But that's how people do it, and so they end up raising rents, right? The rise in inflation meant workers lost more ground in May, with real wages declining 0.6% from April and 3% on a 12-month basis. So There's no good news in that. There's no good news. That's just bad, bad, bad. And obviously that's why the market's tanking here today, right? And you see stuff like this: strong inflation, anxious consumers add up to more worries that the recession has already arrived. And this is a big debate, right? Are we already actually in the recession and we just don't technically know it yet, right? And when you see stuff like this, it kind of feels like it, but you don't really feel a real recession, in my opinion, until jobs are lost. Until jobs are lost, people don't really recognize a recession. Slowdowns in spending, companies' profits falling, companies' revenues falling, even potential margins getting worse for companies. No one really recognizes that. People start to recognize a real recession when jobs start being lost, right? That's when you really start to recognize that. And that's the next thing that's going to essentially start happening here. Tech layoffs topped 15,000 in May. And we've already heard several companies so far in June also announced they're laying off in the tech field. The VC space is in a lot of trouble right now, and this is just there's going to be a lot more layoffs before this gets any better. A lot more layoffs. Okay. Now, to add insult to injury in this whole situation is the big tech companies that you could usually rely on to just hire up everybody left and right. These companies are maybe not doing layoffs, but what they're doing is some of these folks that are maybe, you're always going to have a certain amount of workers that leave your workplace. Some of these companies aren't going to fill those positions, or if they do fill those positions, they'll fill it with workers from Europe, where it's a lot cheaper, or from China, because Chinese workers are a fraction of the price of like Silicon Valley engineers and developers and those sorts of folks. And so there's just a situation that honestly the tech wreck in terms of jobs lost and those sorts of things is going to get much worse before it gets better. I can tell you that much worse. These companies will always technically hire, but they're only going to hire the absolute creme de la creme. The days of hire any engineer or developer that's a thing of the past now. Okay, I can promise you that. And I know several people that work for those different big companies, and they all are telling me the same thing. Okay, now, the next thing to fall is restaurants and food service. So, when you start talking about inflation slicing and dicing people, at the end of the day, people start cutting back on, going to the bar and going to the restaurant, places like that. And this is a massive, massive workforce. And so what's going to end up happening there is people are not going to get the hours they used to. Now, the interesting thing about the restaurant food industry is, you don't necessarily sometimes get laid off. So what will end up happening is maybe you used to work 30 hours a week, and now all of a sudden you're working 20 hours a week, right? Or maybe you're a waitress or waiter and you're working technically the same hours, but the difference is you're not waiting as many tables, the average check isn't as high, which means essentially you're not getting as big of a tip as you were before. And maybe now instead of waiting, 3 tables at a time, you're only waiting 2, right? In situations like that happen. So you're still working the same amount of hours, but you're making less money in the end. And so that's when it's going to start playing out in the restaurant industry. And this is one of those things, you're not going to necessarily see it show up on the unemployment numbers, but it's going to start happening, in which ultimately means those people are really in a recession. Like if you start making less money plus inflation is, high, you're in your own recession, right? Just bottom line there. And this is not a small industry. This is a massive industry, and that will be the next one to start getting hit. Then after that, home sales. So home sales are starting to dry up fast, and I mean really, really fast. And by the end of this summer, there will be no debate. There will be no debate on if real estate is in a bad situation or not. There's still some folks that try to debate it, right? Because they look out and they're like, oh, I see homes getting built over there, and I see, my neighbor's house sold, last month or something like that. That's all backwards looking data. Those homes you see being built right now were under contract 6 months ago, 12 months ago. That neighbor's house, it sold, but it sold, oh man, oh boy, let's pause this. That neighbor's house has slid through and got a sale. I can promise you, in a couple months, it won't be getting that sale anymore because the interest rates are going up. Consumer confidence is through the floor right now. And this is just an awful situation for real estate. We're in a real pickle, okay? I don't want to call it 2008 through 2011 for real estate, but we're in a bad situation. Agents, obviously, mortgage workers, these folks, this is a huge amount of people that have jobs in this industry, right? Their money's going to start to dry up big time. If you can't move houses, like, you can't make money, and that's what's going to start happening. So there's going to be a lot of homes that are listed that aren't selling, and so the agents and all these folks are not going to make any money in the end, right? Because you don't make money until that property sells, that commission comes through, right? And that's just not happening. Refinance is already done. Like, that's done. And there's already been a lot of layoffs there. Refinancing will be in a bad situation for at least the next year, but probably in the next several years, to be honest, when it comes to refinancing. So, we're talking about, those are millions of jobs, right? New home sales are going to dry up at a rapid clip starting this summer. It's already starting. I almost guarantee you, if we got to see Lennar, Pulte Home, KB Home, Toll Brothers, if we got to see all those companies' numbers today, I'd almost guarantee you new home sales are drying up over the past 30 to 60 days in a massive, massive way. And it's going to get way worse, because who the heck is going to go out this summer, right, and pay a sky-high price to have some new home built when consumer confidence is at ultra-low levels? We're likely already in recession or going to recession. Inflation's slicing and dicing people, right? Mortgage rates have gone through the roof. Who's doing that? No one's going to be out there doing that, man. So what's going to end up happening is new home sales are going to dry up massively, and this is going to be an absolute disaster for new home sales being built in 2023, which essentially is going to mean in this industry, there's going to be either a lot of jobs lost or a lot of folks are going to make a whole lot less money, right? And, this house I'm in right now, I just took this photo, and, this is a house that I bought in the when there was kind of like peak fear in probably March of 2020. I signed for this house, and it was done at the end of 2020, right? And I just took this picture of this little part of the kitchen, right? Because I'm like, look at all the companies. Imagine all the workers that made money off this house being built, right? The folks that were painting the house, the folks that make the doors, the people that make the microwaves and make the ovens, the people that make the faucets, and the plumbers that have to do all the plumbing for the new house, right? All the little accessories you buy that you wouldn't usually buy, but because you're buying a new house, you get all these little random things that you wouldn't usually buy. And how many businesses and companies, benefit from that? The cabinet companies, the electricians, the flooring people. Like, there's so many people that make money off of a new home being built. Is ridiculous. And it's the best thing. It's honestly one of the best things that ever happens for the U.S. economy. One of the best things to ever happen to the U.S. economy is new homes being built. It's absolutely amazing. And apartment complexes and all that stuff. Because when those things are being built, right, which are almost always being built on debt for the most part, the high majority of them, when those things are being built, so many jobs are created. So many companies benefit. It's amazing, okay? And it's been amazing. But it's not going to be amazing in 2023 and probably even in 2024 as well, but I'm only going to predict 2023. And so we're going to be in a situation where multifamily, new construction dries up, and simultaneously, residential construction dries up. And so all these people that have been making all the money, the guys making the cabinets, now they don't need as many workers down at the cabinet factory, right? Or the folks that are installing the cabinets. All these little, accessory companies aren't doing the sales they used to. The countertop people aren't moving the countertops like they once were, right? The electricians' work starts to dry up, right? The flooring people, that starts to dry up. And so all these things that, were a huge boom, right? All of a sudden, it's not there in 23, right? And that's just a disaster. You look at the landscape companies. When you build a new house, guess what? You got to put it in a backyard as well. And all the jobs that are created from that. You build a pool, and all that creates a ton of jobs. All the tile work and all those sorts of things, right? This all creates massive amounts of jobs, the landscaping and the bushes and all this stuff, right? And you might go buy some new furniture, and some salesperson makes a commission off that, and the furniture company makes money off that, right? And the person that builds that furniture makes money off that. And it's a great thing for the economy. But when that dries up, like it's going to dry up in 23, it's a disaster for the economy, because then all these people that were making money doing all this stuff aren't making that money anymore, right? And that's bad. Okay, that's bad. And so this is why I am not necessarily very excited about the overall state of the economy in the back half of this year and going into 23, because I'm thinking about all the jobs that are going to be lost, or the people that are going to make a fraction of what they were making before because they don't have that work. So maybe these guys building the pool, they were working 5-6 days a week nonstop, right? Making really good money. And now all of a sudden they're working 3 days a week, right? Or one of the crews in general gets laid off. And, if they just end up cutting the amount of jobs, let's say they don't actually lay off a person, it doesn't hit the number, so it doesn't make unemployment look like it necessarily jumped. So it's a trick, right? But that guy who's down here, helping do the plaster or the pebble or whatever, right? Maybe he's making himself, $800 a week for his family, right? Or $700 a week. But if business starts drying up, all of a sudden he's making $300 a week, $400 a week for his family. And when inflation's the way it is, it's not a good situation, right? Which leads to people having to start moving in with other people, roommates, families starting to get together, aunts and uncles moving in and cousins moving in and all that stuff. That's what ends up happening. And that's just kind of like, it's a dominoes falling the wrong way for the whole game, right? Retail's next to start falling. And retail's a very tricky industry. And I worked in retail for many, many years. And I can tell you, this is another one of those trickster industries, because it's not like, let's say Walmart, right, isn't quite doing the sales they need to do. And so what are they going to do? They're not necessarily going to go lay off or fire a bunch of workers. No, what they're going to do is they're going to cut Sally from working 28 hours a week to now Sally's going to work 17 hours a week, okay? Johnny, who was working 38 hours a week, Johnny just is going to get cut down to 22 hours a week. That's how retail is played. They don't go and just fire everybody and lay off everybody. They cut your hours. And then you end up having to go get a second job, or you end up leaving, right? So you weren't really you didn't get fired. Technically, you didn't get laid off, but your hours got cut. That's the way that industry works, right? And so think about how many people are going to be facing that situation. We got a perfect example of one of the biggest employers in all the United States of America here today. Target. Target's one of the biggest employers in all the United States, right? They're slashing prices to clear inventory. Their sales aren't there right now. Things like that, right? Except for food and makeup. That's doing really well for them. But outside of that, their business is not in a good place. So if Target's not hitting numbers, right? If Target's not doing that great amount of business, if Target has profitability issues, what's Target going to do? They're going to start cutting employees' hours, okay? And, Dominique, who was getting 32 hours, is all of a sudden getting 20 hours. That's the way it happens in retail. And so it doesn't show up for the numbers, but it ultimately leads you into bigger and deeper recession, and it's just an awful situation, okay? Now, with that being said, I'm out here buying stocks. What am I out here buying? I bought some Oatly today. I bought some PayPal. I bought Amazon. I bought Chef. I bought Honest. I bought Meta. I bought Corsair. Regardless if there's a recession, all these companies, other than maybe Corsair I'm a little worried about, all these companies are going to grow their businesses. It doesn't matter if there's a recession. Oatly's going to grow like a beast regardless. PayPal's going to grow. Amazon's going to grow. The Chef's going to grow insane regardless. And actually, I think that I won't get too into that, but regardless if there's a recession, they'll grow. Honest is going to grow. Needs-based. No matter what, they grow. And Meta will grow no matter what, right? And for Meta, Amazon, PayPal, they won't grow at quite the clip that you might have hoped they would grow at, but they're still going to end up being growth. They still will grow in 22, and they'll still grow numbers in 23. And so, I'm trying to buy companies, obviously, that I believe are going to grow regardless, right? And so I think that's just kind of very, very important. And even if you're bearish, you have to buy in these sorts of times. And it's so flippin' flapjack and hard for a lot of people to do it, because they're looking at it and they're like, but there's so much bad news, and there's job losses coming likely, and economy is going to get worse. At the end of the day, even with all that fear, you have to be a buyer. That's just what you have to do. Now, the pain is not stopping, right? Adobe down 7% here today. This stock is now down 30% year to date. For Adobe, one of the best business models in the world, Shopify down another 6% here today. That stock is now down almost 75% year to date, right? And it's like, where is the heck is the bottom for a stock like Shop? NVIDIA had this incredible earnings. Their conference call was insane. We listened to the conference call inside the Prep Stock Group, right? And it was like a kind of a learning thing, because basically over this next month I'm listening to all these different conference calls and recording myself listening to them and pausing at different points of these conference calls and things like that. We did it this past week on NVIDIA. The conference call was amazing, but it doesn't matter. NVIDIA is going down. Like, it doesn't matter what NVIDIA says. It doesn't matter how good the conference call is. It doesn't matter how good the earnings are. In this sort of market, like, the stock has nowhere to go but down. And that's why the stock's down 43.5% now year to date. And it's down another 5.7%. If the NASDAQ keeps selling off, NVIDIA's going to keep going down. It doesn't matter their earnings. Doesn't matter their artificial intelligence opportunity. Doesn't matter how good their earnings have been in the past. Doesn't matter how good their earnings will be in the future. If the NASDAQ keeps going down, NVIDIA will keep pushing lower. It'll keep underperforming, and that stock will go down 50, 60% year to date. That's just the way it happens, right? But at the end of the day, if you love NVIDIA for the long term, you got to step out there and you got to buy on a day like today, right? And you might see that and you might say, man, can I really buy on a day like today? What if it goes lower? It's kind of like, imagine you see, let's say you love drinking Pepsi, right? And so you go to the grocery store and a 12-pack of Pepsi is usually $4.99. That's what you usually pay. And then today it's $2.50. And you're like, oh man, it's $2.50. This is awesome. I usually pay $4.99, but you're like, I don't want to buy it because, I don't know, maybe next week it might be $2.25. Maybe it'll be $2 next week, right? And yeah, that could be a possibility, but you could also go back next week and that Pepsi's $3 now, and it's $3.50 and it's $4, right? And you're like, oh man, I love Pepsi, but now I got to buy it for $3.50 instead of, $2.50 like I could last week. At the end of the day, if you see a great deal, you got to take advantage of that deal, regardless of the market and regardless that it could go lower, right? You look at a stock like PayPal, down 5.5% here today. This stock's down 60% year to date. Something to remember with a lot of these stocks is they're pricing in recession already, okay? And so, when we actually get confirmed recession, whenever that happens, right? And whenever we get confirmed job losses, if some of these stocks start to bounce while you're getting the bad news, don't be shocked. That's all I'm going to say about that, because many of these stocks are getting so beat down that they're already pricing in job losses, recession, economy not being in a good place for the next 1 to 2 years. They're already pricing it in. That's how you get stocks down 30, 40, 50, 60, 70%, because they're already pricing that in, okay? And so there's something very important to remember. And remember, the stock market bottoms way before the economy bottoms, and bottoms way before real estate bottoms. Remember that, okay? And it's also the first to get hit before all those other things get hit. Look at a stock like Amazon, obviously maybe arguably the best company in the world, down over 5% here today. The stock's down 35% year to date. I'm out there buying Amazon today. I don't care. And if it goes down to 100, great, I'll buy more shares. If it goes down to 95, great, I'll buy more shares. But at the end of the day, I'm not going to look at Amazon down 35% year to date, and be like, I'm not going to buy it because it might go lower. I'll buy more shares if it goes lower. I welcome it. I hope it happens, right? And Netflix down 5% here today. This stock's down 70% year to date, almost 70% year to date, 69.3% year to date. Remember this about Netflix, okay? If, let's say hypothetically, there's a recession, right? People lose jobs, those sorts of things. What I can tell you is one of the last things that will be cut is Netflix, because people need entertainment at the end of the day. They really do. And so people will cut back on that vacation to Hawaii. That's going to cost them several $1,000s. People will cut back on the vacation to Vegas, my city I mainly live in, right? I'm in Arizona right now, but my city, Vegas. They'll cut back on that trip, right? They'll cut back on vacations, things like that. They'll cut back on the trip to Disneyland and big expenses. But $12 a month or $15 a month or whatever for Netflix, people will keep that. And so do keep that in mind. Do keep that in mind, guys. I think that's just worth kind of, keeping in your head, okay? Meta down another 4.5% here today. Meta down 48% year to date. You gotta be flipping my flapjacks, Gotta be out there, gotta be buying, on a day like today, right? Tesla down 3% plus. This stock's now down almost 42% year to date. Obviously, it's been a tough run for Tesla here. If I had to guess, I think it will get worse before it gets better in terms of Tesla stock price. For the stock to go down 50+% year to date, I don't think it's out of the realm of possibility. I mean, heck, it's already 42% on the way there. When it comes to Tesla, the situation with Tesla is when people are fearful of a recession, automakers aren't going to do well. That's just bottom line. And at the end of the day, Tesla's an automaker. And so if there's real worries about a recession, and we actually get that confirmed recession, like Tesla's just not going to do good, right? And their EPS will start getting hit. They won't be as profitable, and because their factories won't be as scaled. And then you'll have worries about like people canceling orders on cars and things like that. So you have all these sorts of concerns that will push the stock down further and further. And so for a stock like Tesla, to imagine the stocks it's all of a sudden down 50 or 60% year to date is not a crazy thought at all, in my personal opinion, because heck, you're 42% of the way there. You're already down 42%. You're actually a lot more than 42% of the way there, right? And so do keep that in mind for a stock like Tesla. It could get a lot worse before it gets better. Let's just put it that way. Apple's another one of those stocks I put in that category. For Apple, this stock hasn't been hit nearly as hard as I think it will get hit ultimately, especially if this market continues to be risk off. The stock's only down about 25% year to date so far. Here's a deal, man. There's going to be so many people passing on the next iPhone. It's going to be ridiculous. The only people buying the next iPhone are maybe like super rich people that just have too much money and don't care about spending another $1,200 on the newest iPhone, or people that maybe break their iPhone or something like that. But I can tell you, Apple's customer base is so huge nowadays that when consumers are in a good place, it's going to end up hurting Apple's numbers in a big, big way. And so there's going to be a lot of people that end up passing on this next iPhone. Apple's numbers are probably going negative, in my opinion. I really think their revenue is going negative in 23. I really do. And even in the back half of these quarters, in the back half of this year, 3Q, 4Q, I don't think it's out of the realm of possibility at all for the revenue to go negative here. Services has been a huge growth engine for Apple for years. I think that's going to have a huge drop off. The reason being is so many people were, when everybody was at home, so many people were spending money on games and all the stuff that Apple takes their tax on, basically the Apple tax, right? Which they taking their money. And, that was great when stimulus was out there and everybody was forced to be home and people were flush with money. I think that's going to dry up big time. That's going to hurt the services numbers in a major, major way. And Wall Street's going to go, oh crap, services, we had projected that to be growing at ... and it's only growing at this. And then simultaneously, when you're going to have iPhone sales likely start shrinking on a year-over-year basis, starting as soon as next quarter, that's when all of a sudden people are going to freak out with Apple. People are going to freak out because they're like, oh my gosh, iPhone sales are starting to go down. Services is dropping. The growth rates aren't even close to being what we thought they were going to be. And so for Apple to go down 40% plus year to date in 2022, I don't think that's crazy at all. For this stock to drop down to a 110 range or $100 range, I don't think it's crazy at all. Unfortunately, that's going to hit the S&P 500 more. Never mind that, oil and gas will start dropping in the back half of the summer, in my opinion. So that's going to hurt the S&P 500. So we likely have more pain coming for the S&P 500. Keyword is likely. Doesn't mean it's guaranteed. It's just likely, in my opinion. And I think Apple's got further fall. Am I going to short Apple? Absolutely not. No. It's tempting because I do think this one's going a lot lower, but I can't short Apple. They can pull rabbits out of the hat. You never know. Maybe even in a recession, they could somehow get people to buy $1,200 iPhones at record clips. I don't think it's happening. I think it's very unrealistic, but you never know. And so I'm not going to touch that baby in terms of shorting. Okay, housing stocks likely have a lot more to fall, but do keep in mind almost all these companies are in a better financial position than they've ever been in terms of their balance sheets. They have a lot of money to buy back shares if their shares go lower, so that gives a little floor under their share price. So, am I short in housing stocks? No. Do I believe in housing stocks at all for the next 12 to 24 months? Absolutely not. I do not believe in those babies at all, okay? Maybe at some point I step in and maybe buy something like an RH, but not right now, man. Not right now. That might be a 2023 play. And so I've been doing a lot of research on RH and just getting myself back caught up with the business. It's been a company I've followed for many, many years. And maybe in 23, I step in to that one, but I'm not in a rush for any of those, right? So, at the end of the day, buy the dip and never trip, Despite all the drama that's going on out there, all the stuff that's happening, right? You've got to be a buyer out there, despite all the bad news and all the bad stuff going on. If you guys missed any of the videos I came out with this week, definitely check out those. This one especially, I'm pretty happy with that one. I went to the field to get you guys video evidence of what I think is the mother of all bubbles. Okay, so definitely check out that video there. And obviously I always release a lot of content. Check out the description area. Got all types of fun stuff down there. Much love. Buy the dip and never trip, and have a great day.